Hi everybody. Welcome back to our series of Chapter 19 video lectures. In this video, we'll discuss the accounting for stock option plans when options are exercised and what happens when unexercised options expire. When options are exercised, we will replace the amount accumulated in the paid-in capital stock options account in connection with those exercised options with a credit to common stock and paid-in capital in excess of par. Of course, the amount accumulated in the paid-in capital stock options account would depend on the amount of forfeitures the company had recorded prior to the vesting date. Over the next two slides, we will continue using the example of Universal's grant of 10 million stock options on January 1st, 2021, and we will assume that there were no forfeitures prior to the vesting date. Under this assumption, compensation expense was debited and paid-in capital stock options was credited for $20 million in each of the 4 years in the vesting period. Accordingly, by December 31st, 2024, at the end of the 4th year in the vesting period, the paid-in capital stock options account had an accumulated $80 million credit balance. Let's look at the original terms of the option. Recipients are allowed to acquire 10 million shares of the company's $1 par value common stock within 8 years following the January 1st, 2021 grant date. The exercise price of the shares is $35 per share. Now let's assume that half the options, 5 million options, are exercised on January 11th, 2027, when the market price is $50 per share. To record this transaction, Universal completely ignores the $50 per share market price, and they debit cash for $175 million, which is the exercise price of $35 per share times the 5 million shares exercised. That's the cash they received. They must debit paid-in capital stock options for half the balance in the account because half the options were exercised. So they debit paid-in capital stock options for $40 million. Then the company credits common stock for $5 million. That's 5 million shares issued times $1 per share par value. The final entry is to credit paid-in capital in excess of par, $210 million to balance. After the 5 million options were exercised and this journal entry was made, there are still 5 million unexercised options, and the paid-in capital stock options account has a $40 million credit balance. If options that have vested expire without being exercised, the entry will be made to replace the amount accumulated in the paid-in capital stock option account in connection with those expired options with a credit to paid-in capital expiration of stock options. Let's assume in our example that no more options were exercised after the 5 million shares exercised on July 11th, 2027. Therefore, when the remaining 5 million options expire, the company will debit paid-in capital-stock options, $40 million, to zero out that account balance, and credit paid-in capital-expiration of stock options, $40 million. In effect, we simply rename the paid-in capital attributable to the stock option plan with paid-in capital-expiration of stock options. Also, no entry is made to change compensation expense already recorded for the 4 years of service. Well, that's all for this video. In the next video, we'll discuss vesting schedules.